Sarah Friend, and I'm an employee benefits consultant with the Partners Group. And today's webinar is regarding the new employer reporting requirements under the Affordable Care Act. This is a recorded session at the request of many of the attendees who were able to log in and participate in our webinars in mid-January for both fully insured and self-funded clients. Today is an abbreviated recording of those sessions for employers to share with team members who were either not able to participate or they weren't able to participate themselves. We had well over 200 of our clients and their team members join the webinar, so we hope this information is valuable to you as you begin your understanding of what the new law is going to require of you in 2016 for reporting on the 2015 calendar year. We're going to start this presentation with a little bit of humor. The feedback that we got from clients from our webinars was, gosh, this is really difficult information to swallow. It is dry at best and painful at the worst. So this first cartoon is an image of an individual being pulled over at the side of the road. And instead of a police officer approaching the car, it's an IRS agent that explains simply to the surprised driver, "No, I'm from the IRS. Your health insurance papers, please." When we think of this topic of employer reporting, we can picture this IRS agent pulling people over on the side of the highway and asking for our proof of insurance. Whether we're an employer who is an applicable large employer mandated to offer coverage to our employees, or if we're an individual who is mandated to have minimum essential coverage for ourselves and our families. Employer reporting really functions in the same way as this IRS agent. It is the means by which employers and insurance carriers will provide proof of insurance to the IRS so that both the employer mandate and the individual mandate can effectively be policed at the federal level to ensure that we are all doing what we're required to do under the law or be assessed the applicable tax penalties, whether that's an individual or applicable large employer. So this presentation is intended to do a couple of key things. First, it's intended to simply educate you and your team. It is to ensure that our clients have an opportunity to get a closer look at the reporting requirements under the new law. The IRS issued draft forms and instructions late last year that finally gave us an opportunity to get a preview of what will actually be required of applicable large employers. We've been talking about employer reporting for a long time, and while some of today's presentation is going to be a review of the ACA mandates at a high level, it will get to a more detailed level and will actually take a peek at the actual forms themselves so that you can get a more tangible understanding of what will be required under the law. This presentation is also really intended to prompt dialogue, or whether that's between an HR department and payroll or finance, to ensure that everybody is on the same page and somebody has been designated as the department or individual who's going to be responsible for employer reporting, or whether that dialogue is between your organization and your external vendors, primarily your payroll vendor or your HRIS system. This presentation is also intended to introduce you to some resources and let you and your team members know what information is available out there on the web and from the IRS that may help you and your team better understand what's required of you and practically what you're going to need to do in order to prepare for upcoming employer reporting requirements. And finally, it's just to help focus you and your team on and to help you prioritize any ACA tasks that are still outstanding. This presentation is not intended to make anyone panic. We really hope that this presentation doesn't leave you feeling like Beaker here. While it is time to ensure that you have team members actively engaged in learning about employer reporting and ensuring that your systems and processes are prepared well in advance of next year's deadlines, today is not intended to push any alarm bells. Because you are listening to this webinar, it means that you are at the beginning, you are beginning the conversations necessary to ensure your readiness for compliance. If you started this presentation feeling a bit panicked, I hope that by the end of this presentation you feel a bit more confident in the appropriate next steps. In addition to not pushing the alarm bell, this presentation is also not legal or tax advice. I am not an ERISA attorney, nor am I a CPA. So please note that this should be considered high-level information and should be understood as general information that's just giving you guidance on the appropriate next steps. It's also not the final word on ACA. The one thing we know about the Affordable Care Act is it changes a lot and frequently. And finally, it's not a political opinion. Love it or hate it, the Affordable Care Act is likely not going away between now and 2016. And so we should get our arms wrapped around employer reporting so you and your teams aren't caught off guard. So let's start with an overview. What are the reporting requirements? So the new tax reporting requirements under the law itself are covered under two sections of the ACA. There's IRC Section 6055, which is the reporting of minimum essential coverage. And this reporting requirement is really to serve the needs of policing the individual mandate. So Section 6055 is really required to ensure that the IRS knows from either self-funded plans who sponsor a self-funded health plan or from an insurance carrier who provides insured coverage to individuals, that the IRS has proof of who got coverage from what source. In addition to 6055, there's IRC Section 6056. This is the section of the Affordable Care Act that requires reporting of applicable large employers under the employer mandate. So 6055 ensures that the IRS knows who had minimum essential coverage for purposes of policing the individual mandate, and 6056 is the section of the Affordable Care Act that ensures applicable large employers are reporting to the IRS if they offered minimum essential coverage that's affordable to their ACA full-time employees for the purposes of policing the employer mandate. It is also not just to provide the basis for the IRS enforcement of the employer mandate and the individual mandate, but it also is the basis by which premium tax credits for the exchange and marketplace can be policed. So for example, if an employee of your organization goes to the federal marketplace and applies for federally subsidized health insurance, that information that they're putting into healthcare.gov is just, they're basically self-reporting their eligibility for federal subsidies. It's not till the end of the year that the IRS then learns, did this individual actually receive an offer of affordable minimum coverage from their employer? If they did, then they would not have been eligible to receive those individual premium tax credits and may have to pay those back. So who must report? All applicable large employers, or ALE as the abbreviation, as defined under the Affordable Care Act, must comply with the new reporting requirements. So an applicable large employer is any employer who employed on average at least 50 full-time equivalents on business date in the prior calendar year. Now, this does not have anything to do with your plan year. So if you have a July 1st effective date of your health plan. Doesn't have anything to do with the way that you measure whether or not you're an applicable large employer. Now, most employers are going to obviously know they're going to be well over under that 50 threshold. But if you hover around that 50 full-time equivalent mark, make sure that you're aware of, one, how in 2015 you may be able to use the 6-month transition relief rule that allows you to average your full-time equivalents over 6 consecutive months in 2014 versus having to average it over the full calendar year. Reporting requirements, another note here is the reporting requirements if you are an applicable large employer with at least 50 full-time equivalents measured in 2014 for the 2015 determination. Reporting is not delayed for mid-size employers. We'll talk more about the fact that while penalties are delayed for mid-size employers with between 50 and 99 full-time equivalent employees, those mid-size employers, they're still an applicable large employer, and so they are still subject to these reporting guidelines, even though there's a 1-year delay of any risk of penalties. Applicable large employer is determined on a control group basis. So if you are an employer that has any brother-sister organizations or anything like that, know that you are determined to be an applicable large employer in the aggregate. So if there's 3 businesses that qualify as a control group, those 3 businesses, your full-time equivalent employees of all 3 businesses are aggregated together to determine if you meet the 50 full-time equivalent employee mark. If you do, in aggregate, each one of those 3 employers is considered an applicable large employer and would be subject to the reporting requirements under the new law. If you're not sure if you're an applicable large employer, please reach out to your TPG team member for assistance. So the next slide. So I'm pretty sure I'm an applicable large employer. I'm well over the 50. When is my first report or statement due? So individual statements, and we'll go through what those are. Individual statements must be provided to the individuals, your full-time employees, and any individual covered by your self-funded health plan by January 31st of 2016 for this first year of reporting. These individual statements are provided by the employer for self-funded health plans and are provided by the insurance carrier for fully insured plans. Returns must be provided to the IRS by March 31st of 2016, and a little bit sooner if you're filing by paper. Electronic filing is going to be required if you are an employer with at least 250 returns or individual statements. There is voluntary reporting in 2014, which would mean that anybody who wants to step forward and do voluntary reporting would need to start filing their reports in early 2015, so they'd be working on those right now. And then mandatory reporting begins for everyone for the 2015 calendar year, which means that for the most part, most employers will be filing their first individual statements and statements to the IRS in the beginning of 2016. There are penalties for noncompliance in employer reporting. The penalties are up to $100 per return with a maximum penalty of $1.5 million per employer. So what forms will actually be used to satisfy these, both the employer mandate reporting requirement and the individual mandate reporting requirement? There's 2 forms that all applicable large employers need to get their arms kind of wrapped around. The first is a 1094-C, which is basically a transmittal form used to report summary information about your organization to the IRS. The 1094-C form can be referred to basically as a cover sheet. Most organizations will be filing a single 1094-C form. Then, in addition to that, you've got individual statements for each of your ACA full-time employees. In addition to that, if you're a self-funded plan who extends benefits to employees below 30 hours, you would also file a 1095-C form for any members who are covered by your self-funded health plan, even if they're not ACA full-time. So who is ACA full-time? If you are a member of a control group, each applicable large employer, so that example that I gave earlier of the 3 companies that are considered a control group, each one of those 3 companies is responsible independently for identifying its ACA full-time employees for the purposes of reporting. ACA rules identify 2 options for applicable large employers to use in determining who is ACA full-time within their population. The rules basically state that an employee who is working 30 hours or more per week within your organization would be ACA full-time. Now that sounds pretty simple, but I'm sure most of you have gone through the painful discussion of whether or not you're going to use the monthly measurement method or apply the look-back measurement method to make your full-time determination of your employees. Once your organization has decided whether or not you're going to apply the monthly measurement method or the look-back measurement method, ALE members should document the decision and establish your written procedures for the administration of these new rules. If you need assistance with this process and have not yet finalized this step, please reach out to your TPG team. All right, so this is my warning. It's been pretty high level so far, pretty easy, I hope, to follow, nothing really new, but there are details ahead in this presentation. So consider this our warning slide. We are going to dive deep into the weeds, not because it's fun, but because we think it's a necessary part of learning. Walking through the actual forms, we believe, will help individuals within your organization begin with the end in mind. If you can truly see the end result and the output of these forms, we hope that it will help clarify for you what the reporting requirements will really mean to your organization and help identify which external partners you may need to engage in this conversation of readiness. In order for you to determine that you're tracking all the necessary data points in your system, it is important for us to review these actual forms so that you can see exactly what will be required of each ALE member in early 2016. I promise that I will not go through the 14 pages of IRS forms and instructions, but I do want to call to your attention that the 14 pages are readily available out on the IRS website for your team to review. Once you've identified which department in your organization and what key individuals will be accountable for employer reporting, it may be helpful that they realize that these draft instructions are available for them to review. Note they are draft and the final instructions have not yet been published, but we do believe that even reviewing the draft will help ensure that you understand the basic components of what will be required of your organization. So if you want to find the 14 pages of instructions, just do a quick Google search for 1094C and 1095C instructions and forms, and it'll direct you directly to the IRS website. There are 3 basic methods of reporting that are allowed under these rules. The first is the general method. The general method requires the greatest amount of information collection from employers. All large employers with 50 or more full-time equivalent employees are required to use this method unless they qualify for reporting relief provided by the 2 alternative methods that we'll describe in a moment. I don't want you to walk away thinking that the alternative simplified methods allow you to not have to report. All applicable large employers will be required to report. It's simply, if you qualify for an alternative method, there are a couple key pieces of information in the forms that you get to leave blank if you're enlisting one of the simplified methods and you qualify to use those. When using the general method, the employer must file a 1094-C form for the company, as we stated, and 1095-C forms for each full-time employee and non-full-time employees who are covered by your self-funded health plan. The employee must also receive a copy of the 1095-C forms. Employers are required to use this method will begin collecting the following data for 2015 reporting purposes. There'll be basic information about the employer, and you'll see where that's collected on the form when we actually look at the 1094-C form. You'll also report certification as to whether the employer provided minimum essential coverage to full-time employees and their dependents for each calendar month. You'll also report the months that minimum essential coverage was available to each full-time employee. So if you didn't offer coverage to your employees until July, you actually have to show no for January through June, and then by month, July, what months you offered minimum essential coverage. In 2000, you'll also have to report each full-time employee's monthly cost for employee-only coverage under the employer's least expensive minimum value plan. So it's bronze level or higher. So if you offer employees with 3 plans to choose from, and those employees have 4 tiers of enrollment options to choose from: employee only, employee plus spouse, family, employee plus child or children. In this box, you're going to be actually reporting the same cost for the majority of your employees if they're all subject to the same contribution schedule. Because regardless of which plan they actually enroll in and which tier they actually elect to enroll in, you're going to be reporting the cost for employee-only coverage for your lowest cost plan. This goes back to how affordability is measured under ACA. And it's measured based on the least costly bronze level plan for single coverage. Then you're also going to report the number of full-time employees employed each month in the calendar year. You're going to report the name, address, social security number of each full-time employee employed during the calendar year. So even if an employee only works for you for 1 month, that employee is going to get a 1095-C form. And then for each employee, the months each employee was covered under the group health plan during the year. The qualifying offer method is slightly simplified, and this is available for employers who made what's called a qualifying offer of coverage in 2015 for any employee who was full-time and for whom an ACA penalty could potentially apply. The plan is only considered a qualifying offer if the minimum essential coverage that's offered to the full-time employee meets the 60% actuarial value test, if the coverage is offered to the employee, their spouse, and eligible children, and the cost of employee-only coverage cannot exceed 9.5% of the federal mainland poverty level, which is equates to about a threshold of $92.38 per month. If your coverage meets the 60% actuarial value test, if you're extending it to employees and all their family members, and you're not charging more than $92.38 per month for your lowest cost plan for single or employee-only coverage, your offer would be considered a qualifying offer to your full-time employees. And as a result, you would be eligible to use this slightly simplified method of reporting. So how is this reporting different than the general method? In this, if you want to employ the qualifying offer method, the employer is not required to report the actual cost information on a monthly employee-specific basis on your 1095-C forms. And again, you'll see where that applies when we look at the form itself. For employees who receive a qualifying offer for fewer than 12 months of the year, the employer can use the code for the qualifying offer method for any month in which the coverage that was offered does meet these 3 tests: 60% actuarial value, offered to employee and family members, and employee-only coverage doesn't cost more than $92.38. If the employer makes a qualifying offer, so an offer that meets those 3 tests, to at least 95% of its full-time employees, then that employer would qualify to use the qualifying offer method 2015 transition relief. This is available only for 1 year, and it allows the employer to not have to report cost for any individual employees, even though 5% or less of employees that did not receive a qualifying offer. There's a final simplified offer method called the 98% offer method. This is not just for 1 year. Under this simplified offer, there is no requirement of the employer to identify full-time employees if the qualified offer was made to 98% of all full-time employees. In order to use this simplified offer method, the employer must certify on the transmittal form, which we'll review, that it offered minimum essential coverage, providing the 60% minimum value, and that coverage, the cost for that coverage didn't exceed the $92 threshold to at least 98% of full-time employees and their dependents. If this certification is provided on the transmittal form, the employer does not need to specifically identify the full-time employees on its actual return. However, the employer still must comply with providing 1095-C forms to all of their full-time employees, and if you're a self-funded employer, in addition, 1095-C forms need to be provided to any subscriber covered by your plan, even if they're not full-time, including COBRA subscribers and retirees, if you extend coverage to retirees. Let's take a look at the actual forms themselves. So first we have the transmittal form. This is the single form that is used basically as a cover sheet for with the multiple individual employee statements, or the 1095-Cs. Most employers will just complete a single 1094-C form. This 1094-C is a 4-part, 3-page transmittal form. As you can see, I've highlighted a couple of key parts of this transmittal form, and we'll go through each one of the 4 parts of this form together. Part 1 is that basic information about the employer. Nothing really tricky here. I'll just point out that language, applicable large employer member, generally is just going to be the name of your organization. But if you are a part of a control group, because you're measured together for the purposes of determining if you're an applicable large employer, that would be the name of your organization. So back to our example of 3 companies, each of the 3 companies is going to file a 1094-C form. And then the final section, or part 4 of this form, is where we would list the other 2 companies that are a part of your control group. Under part 2, that's where it's asking, is the applicable large employer member a member of an aggregated ALE group? So if the answer to that is yes, I'm one of those 3 companies that are considered a control group, I would mark yes to question 21 and then complete part 4. For most employers, the answer to question 21 is going to be no, and if so, I get to ignore part 4 of the form. And back to part 1, questions 9 through 16, most employers get to ignore this because it's only required if you're a designated governmental entity filing on behalf of an employer, which won't apply to most of you. In most cases, because an employer will only be filing a single return, it will be the authoritative transmittal for the applicable large employer member. So most employers will be answering yes to this. But if you're a very large organization and you're splitting up your reporting by division, then each division can complete a 1094-C form, but there must be one authoritative transmittal that basically bundles all of those transmissions together. So for most employers, the answer to this will be yes, as there will only be one form. Question 22 of Part 2, this is where you would certify, if you're an applicable large employer, whether or not you're going to be using any of the simplified reporting methods that we reviewed earlier in this presentation. So box A is the qualifying offer method. So you would mark an X in that box if you've got any individual employees that you made a qualified offer to and you don't want to report the actual cost for that individual employee. If you made a qualifying offer to 95% of your full-time employees, you'd be eligible to mark yes on B, the qualifying offer method transition release, which means you don't have to report costs for any of your employees for which you're filing a 1095-C form for. Skipping over to D, the 98% offer method, this is if you made a qualified offer to 98% of your full-time employees, and this gets you out of not only not having to report cost for any of your employees, but you also don't have to list the number of full-time employees by month. C is whether or not you as an employer are eligible for any transition relief. So this is related to the employer mandate penalties. So there are two reasons that you would select C. The first is if you're a mid-size employer with between 50 and 99 full-time equivalent employees who qualify for the 1-year delay of any assessable applicable large employer mandate penalties. If you're a mid-size employer that qualifies for that 1-year delay of penalties, you can see you still have to report, but you're going to indicate in box C that even though you're reporting, no matter what that return says, you're not going to be assessed any tax penalties in 2015. The other reason that you would indicate that you're qualified for Section 49 ADH transition relief is if you are a employer that has a non-calendar year plan year. So, for example, if you renew effective October 1st of 2015, you are not subject to any assessable tax penalties January through September as long as you qualify for that transition relief. And there's a couple things that have to be in place for you to qualify for that transition relief. So again, that Section C is for mid-sized employers between 50 and 99 full-time employees, and for non-calendar year plan years that renew sometime after January 1st, 2015. Here's part 3 of the transmittal form. So this is where under column B, if you are eligible for the 98% offer method, here is where you would not need to indicate the total number of full-time employees by month. If you don't qualify for that transition relief, if you don't qualify for the 98% offer method, this is where in column B, you would provide the total number of ACA full-time employees by month. You don't count any employees in their probationary period or other limited non-assessment periods like an initial measurement period if you're using the look-back method. Column A, you would indicate for each month which month and an offer of minimum essential coverage was made to full-time employees. Column C is for employers to provide the total number of employees, including full-time and non-full-time employees, for each calendar month. And then column E is where you would indicate if you're eligible in those months for transition relief, either as a mid-sized employer or if you have a non-calendar year plan year. Let's say you renew in May, you're going to indicate for the months of January, February, March, and April that you're eligible for transition relief in those months. So this is where the IRS would see, oh wait, no matter what happened in those months, they aren't eligible, or they would not be assessed, or you would not be at risk of an applicable large employer penalty until your plan year renews for the first time in 2015. Part 4 of the 1094-C form, again, is only used if you are a member of a control group. If you are a member of a control group, this is where you would need to enter the names and employer ID numbers of all other applicable large employers of your aggregated ALE group. Now let's shift gears and talk about Form 1095-C. So for self-funded employers, Form 1095-C form, again, serves two purposes. The first is the employer mandate. So parts 1 and 2 of this form, which we'll go through in a minute, provide information both to the individual and to the IRS regarding the offer of coverage made by the employer to any ACA full-time employee for the purposes of the employer mandate. This information also helps the IRS to police any tax credits that an individual may be applying for through the marketplace. This form is also used to police the individual mandate. So parts 1 and 3 of the form provide the required information to both the IRS and any individual enrolled in your self-funded health plan for them to show that they had proof of their medical coverage for both themselves and any enrolled family members for the purposes of the individual mandate. If you're a fully insured employer, you still need to complete Form 1095-C, but you only need to worry about providing information or providing those statements to your ACA full-time employees, and it's not tied to their enrollment in your health plan because your insurance carrier, whoever provides that individual and their family members insurance, will be the one to provide them with their proof of insurance. You'll need to complete a 1095-C form, again, for any ACA full-time employee that was full-time for any 1 month of the calendar year. So if they were part-time for 11 out of 12 months, they would still get a 1095-C form, even for that 1 month that they were full-time. And again, if you're a self-funded employer sponsoring a self-funded health plan, you're responsible for giving that individual and the IRS proof of insurance under your plan. So here is a copy of the actual 1095-C form. So you can see under Part 1 of this form, it's information regarding your employee. So whether or not this is an ACA full-time employee, that's the only individuals, if you have a fully insured plan, that you need to worry about. If you're a self-funded employer, again, you would provide these forms to any ACA full-time employees, in addition to non-full-time employees who are covered in your health plan. For every 1095-C form, Part 1 needs to be completed for everyone. Part 2 is regarding the employer offer of coverage. So Part 2 needs to be completed for everyone as well. This is information about that polices the employer mandate. So let's say this is for Joe Smith, this is going to report to both the employee and the IRS what offer of coverage was made to Joe for each month of the calendar year for which the reporting applies. In this example, this employer is using the optional qualified offer method, because Joe, for example, was offered a 60% minimum essential coverage plan that didn't cost more than the $92 per month, and it was extended to both he and his eligible family members. So in this case, the employer simply indicates that Joe was made a qualified offer for the full 12 months of the plan year. And in this case, because I'm choosing to use that optional qualified offer method, I don't list anything in line 15. And 15 is just left blank. And then you'll see in what to do in section 16, which is the applicable section, what safe harbor codes you would enter for any month that you didn't offer Joe qualified offer. Part 3 of this form is only required to be completed if you're an employer that provides self-insured coverage. And if that's the case, then you would be completing for ACA full-time employees, you're going to be completing Part 1, 2, and 3 if they're both ACA full-time and covered under your self-funded health plan. If they're a part-time employee or they're a COBRA member or retiree, you would not complete Part 2 for those individuals because you're not subject to the employer mandate for people who are not ACA full-time. So Part 2 of this form is all about the employer mandate, so I can leave that section blank. But if they are enrolled in my self-funded health plan, even for 1 month of the calendar year, I'm going to need to complete a 1095-C form for that individual and complete both Parts 1 and Part 3 of this form. If I am eligible to use the optional qualified offer method transition relief, so I've made a qualified offer to 95% of my full-time employees, then I don't need to report costs for any individuals of my organization. So I'm either going to use one of 2 codes in line 14, and then I'm going to leave line 15 blank for everyone. The indicator codes that are used to describe the offer of coverage, most often an employer is going to use a couple of codes. 1A is for any month that a qualifying offer was met for that individual. And then you've got 1B, C, D, and E that are kind of variations, meaning that it doesn't pass all of the tests. And then you've got 1G is used if it's a non-full-time employee enrolled in a self-funded health plan. You would use 1H if there was no offer of coverage, and 1I for anybody who did not receive a qualifying offer, but that's 5% or fewer employees that didn't receive a qualifying offer because you're using that transition relief qualified offer method. Line 16 is what you would indicate if you were eligible for safe harbor. So in the event you didn't offer coverage to a full-time employee, line 16 is the why not. So this is what allows you to not be at risk of a penalty for a month that you didn't offer an employee who was receiving a 1095-C form coverage for that month. Examples of these codes are they just weren't employed during that month. So if I was hired in July, I'm still going to get a 1095-C form for the full calendar year, but it's going to indicate that the reason I wasn't made a qualified offer for January through June is because I was simply not employed during those months. You can see here there are other reason codes for an employee not receiving a qualifying offer in those months. And these issues would allow the employer to not be at risk of a penalty in those given months. Part 3, again, is only completed if you sponsor a self-funded health plan, and this is for any covered individual who is enrolled in the plan. So exceptions to the self-funded Part 3 of the 1095-C form. So again, if you sponsor a fully insured plan, you would not be required to complete Part 3 of that form. Any HIPAA-accepted coverage, so a standalone dental or vision plan is an example where you would not be required to complete Part 3 of that form. You would not be required to complete Part 3 of that form if the self-funded health plan is a health reimbursement account that simply supplements a fully insured minimum essential coverage plan, or MEC that supplements a primary plan of the same plan sponsor. So what's next? There's a couple key steps that are next. The first is very simply, and will only apply to a couple of groups who are kind of on the bubble, is to make your ALE or applicable large employer determination. If you're not sure if you are an applicable large employer and you need help doing that, again, reach out to your PPG team. The second is to finalize your ACA strategy to limit your liability and ensure compliance under the law. If you wait until late in 2015 to build your strategy, by that time you may have exposed yourself to penalties, as the penalties start January 1, 2015 for plans that renew on a calendar year basis, and then for most employer-sponsored plans that renew on a non-calendar year basis, it's the beginning of their plan year that begins in 2015. You'll want to select and document your process for identifying ACA full-time employees. So are you going to use the monthly measurement method, or are you going to use the look-back method? You'll want to determine who in your organization will be responsible for reporting, and understand the reporting solution that is going to be available to you through your payroll and benefits vendors. It's likely that the information that's going to be required of employers through employer reporting lives in a couple different areas of your system. 75% of this information that's going to flow through and be captured on a 1095-C statement likely lives in your payroll system. So a good conversation to start with is your payroll vendor, to find out directly from them what solutions will they be prepared to assist you with beginning in early 2016 for 2015 reporting. If you have a separate partner for your benefits administration or HRIS system, you may need to determine how to export key pieces of information out of your HRIS or benefits system to then integrate with the data that's coming from your payroll system in order to complete these returns. In most situations, your payroll partner will be creating a solution that, for likely a fee, you may be able to outsource the preparation of these forms to an outside third party like your payroll vendor. So starting conversations early about what solutions are going to be available to you as a client of theirs and a partner of theirs will help put your mind at ease about what somebody is going to be able to assist you with and what your team needs to be creating solutions for if there is a gap in what your payroll partner or HRIS partner can do for you next year. You'll also want to ensure that you're tracking the necessary data that will be required next year. So it's not just ensuring that your payroll vendor or HRIS partner has the necessary structure, but it's also ensuring that you're inputting and using that structure to track the necessary information so that come 2016, you're going to be able to accurately pull from that system. Excuse me. And finally, engage your trusted partners for assistance. Here at the Partners Group, we will not be able to actually complete your employer reporting for you, but we are your partner in helping you through conversations with third parties to ensure that you are ready and confident in your abilities to meet these new requirements in early 2016. So if you are concerned about your readiness or not sure what conversations need to happen next, we really encourage you to reach out to your TPG team members so that they can help facilitate the right conversations within your organization and with your external partners who will be in a position to help you complete these forms and meet the new requirements in 2016. We hope that this information has been valuable to you. Because this is a recording, there is not an opportunity to answer live questions, but we do hope that as you do have questions, you'll send those to your TPG consultant and account manager. Thank you for logging in and linking to this presentation. Again, it is our pleasure to be a partner of yours, and we hope you found this information valuable to your team.